hit my virtual desk this morning. I just skimmed it, and it's an argument for, in terms of labor market search, arguing actually that it will be a protracted, slow recovery because so many workers have been severed from their job relationships. I'm not sure what I think of it yet, but just to say that there are people, and I'm going to let me just read the sentence at the top of this one, and then go back to go back to myself on the screen. That the theoretical models that are out there so far don't really have dynamics. They use what I'm calling the two-period cheat, which is fine. I should prove it because it's actually one of my own specialties. I'm not sure who invented it. Certainly, when I wrote about liquidity traps and all that more than 20 years ago, that was the way I did it. Which is, the two-period cheat is you actually have an infinite horizon model, but you assume that you have a shock in period one, and that everything is back to long-run equilibrium for periods 2 through infinity. And so, although the model formally is infinite horizon, it's as if it were a two-period model, and in fact, and all of the action takes place in period one. So it actually almost looks like a static model, and that's a way to reduce potentially complex dynamics to something that is much simpler. Which is great. I think it's a very good strategic simplification. But events are moving so fast that it's kind of not what we want to. We know that that's not how the world actually works, and or we suspect it may not be the way the world actually works. And so our problem is, how do we deal with the how do we think about what comes after the shock? And that's the models like that can't answer it. Ricardo Caballero says that he's working on a continuous time version, but I'm not sure what that means. It might be something like what Marcus showed with the stochastic end to the pandemic, but in that case, it's not. It's still going to suffer from the same incompleteness, the absence. As I said, the models we have right now don't have intrinsic dynamics. There's just the shock, and then the shock is over. And what we're worried about really is what happens. Does everything go back to normal quickly after the shock is over, or does it not? And the reason that this becomes especially urgent is, so I'll give you again my screen here. Move ahead to, so Ernie Tedeschi and some others have been doing, using various sources of more or less real-time data. We're actually now at the point where we kind of want daily data. But what they're kind of suggesting is that, and multiple sources are suggesting, is that it looks as if, period one, the period of the shock, is kind of, not that the shock has gone away, but we've already seen what these effects are likely to be. That's not totally fair. We don't really know that, but it's there is, if I can say, not much sign in the available data that there's been either much Keynesian spillover from the lockdown sectors to the rest of the economy, or that there is at this point a lot of financial spillover to the economy as a whole. It's the concern, the kinds of issues that the existing literature, this is really weird, the existing literature is 2 weeks old, the kinds of concerns that the existing literature deals with are kind of behind us, and we have new concerns looking forward. Now, that's not an accident. It's not that those concerns, that people were wrong to raise those concerns. The reason that it looks like we probably did not have very much either of a Keynesian or an asset market spillover is that policy has largely offset the potential damage, not completely, but largely. So, going to do our screen again. This is a more awkward process than we would like. Okay, so lots of things we didn't know, like to think about, but we're we're all becoming kind of instant simulated experts on things like what do unemployment insurance claims mean. The You still have a lot of newspaper stories, actually, as of yesterday, that add up all of the new claims for unemployment insurance and say, 32 million jobs have been lost. It turns out that historically, uh, summing up UI claims that way is not. It is a predictor of job losses, but you would think that the coefficient would have to be more than one because not everybody is entitled to unemployment insurance. In fact, the coefficient is considerably less than one. And that's probably because people end up applying multiple times because they've been turned down or whatever. But for whatever reason, that's actually less than one. Continued claims, the number of people actually receiving unemployment insurance, on the other hand, has historically been substantially less. Not only has a substantial number of people who are unemployed as counted not receiving unemployment insurance, but even the movements have been substantially less. So that if you look at at what happened during the Great Recession, there was a big expansion in the number of people covered by unemployment insurance, but it wasn't remotely as high as the number of people who became unemployed. This time around, now, if you look at the current reports, it actually looks as if the growth in unemployment insurance claims has actually been greater than the growth in unemployment. That's probably reflecting the fact that the BLS has undercounted unemployment. And they themselves say that. If you read the report, they say that because they believe that their field people tended to classify people who are not working because of COVID as still employed, and that the actual unemployment rate is probably closer to 20 than it was to the 14.7 reported. But it's still clear that there's been a big increase in coverage, and that's reflecting in large part legislative action. We had an expansion of the coverage of unemployment benefits, and we also had an expansion of the generosity. And while it's taken a while, there were some significant lags in unemployment offices were overwhelmed. Actually, we were talking before this was opened up about the state of New Jersey was desperately seeking COBOL programmers because their unemployment benefit system is so old that it has mainframes that run on COBOL, which nobody under the age of 60 knows. But they've been catching up, and there's just this morning I saw that the Hutchins Center at Brookings believes that for the month of April, about half of the income loss from loss of employment was offset by enhanced employment. The unemployment benefits also became extra generous, an extra $600 a week, and that about half the income loss was offset, with that rising over the course of the month. So we probably actually have had a fiscal safety net extended to people losing income that has made up much of the loss in income, and there's therefore, among other things, contained any possible Keynesian spillover. And in terms of the asset markets, so give you our next one here. This is from the Liberty Street blog at the New York Fed. They were focusing on commercial paper and money market funds, but basically massive Fed intervention. And some of it of actual large-scale purchase of assets, some of it mainly promises that they will, if necessary, buy assets. Even junk bond ETFs have contained the surge in financial market spreads. In a lot of ways, and Marx is using whatever it takes. If there's anybody who doesn't know, that's the famous, Mario Draghi said 3 words and saved the euro. As he said, the ECB would do whatever it takes. In effect, the Fed has already had its whatever it takes moment with regard to asset market disruption. And Ricardo was not wrong to be worried about that. And for a couple of terrifying weeks in March, it looked as if that was happening, but it appears to have been contained. It's funny how we're using that contained became a kind of a joke in 2008, but it's once again, but it does look as if really aggressive Fed policy has limited. So the models that say, okay, we got a shock to one sector because of this crazy uh, uh, new threat that forces us to do a lockdown, how much does that spill over to the rest of the economy, are important and interesting, but actually are not telling us where we're going. They're telling us where we already are. And so looking forward is a different question. Okay, recovery. We really don't have, as far as I can make out, we really are lacking in models that make sense of that tell us how about the pace of recovery. We have metaphors, ideas. I was actually going to mention Milton Friedman's plucking story. Certainly for employment, that's what a lot of us tend to think of. And the plucking story would say that you would tend to return to the original level of employment, which has been true, but it doesn't actually tell you how fast. What it does suggest is that how fast you return would probably depend. The speed of employment growth would probably depend upon how deep you went. So if you have a steep slump, you should expect a rapid return. However, that's not actually what the history suggests, at least not in that simple a form. And so I'm going to give you again the here's the kind of slope that I'm concerned about. So this is the last 6 economic recoveries where I'm giving you the year that was the bottom, the trough of the recession. In doing this, I'm counting, for those who follow such things, I'm counting 79 to 82, which is officially 2 recessions as a double dip recession. And the the slope I have in mind is the slope of these lines. They're the pace of employment growth during recovery. And what you see there is that there are they're not all the same. They fall into 2 broad groups. There's a period of those are the V-shaped recoveries at the top. The recovery from 70, 75, and 82, and the L-shaped or U-shaped or whatever are the more recent recessions. And hoping that people will be able to keep that in mind, because I don't think staring at a slide and listening to a voice is optimal as so far as we can control it. If you look, it does appear that the dynamics of recovery changed quite a lot after 1990 or so. And it wasn't, not everybody appreciated that in 2008. There were quite a few people who basically had some version of a plucking model in their minds and thought that, well, since we've had an extremely steep decline, we're going to have a rapid rebound. But the others, I have to say, including myself, thought that this was not right. That we actually have had, as of if you asked me about just a few months ago, I said there are really just 2 kinds of recessions that happen. But there are 2 kinds, and then now we have something which is quite different. But the question is where it fits into that typology. And the 2 kinds are recessions that were basically generated in the first instance by the Federal Reserve. Sorry, the U.S. centered, although I think that would apply to other countries as well. That were basically generated by tight monetary policy. The Fed raising rates to squeeze the economy because of inflation concerns. So that was what happened in the 69-70 recession. It's what happened in the 74-75 recession. It's what happened in the 79 to 82 double dip recession. And then you have a second series of slumps, which all were very, very different. So let me actually just give you quickly the Fed funds rate picture, just to give you. If you look, it's kind of what you know, but if you look before all of those previous recessions, there were large increases in the effective federal funds rate, gigantic in the case of 79 to 82, that preceded the recessions, and then very large falls in the interest rate afterwards, partly because you could. And basically, once the Fed deemed that inflation was under control, it loosened. Okay, that's not. Although there was some interest rise before more recent recessions, it was much more modest. It was the Fed tapping on the brakes as the economy appeared to be approaching full employment. It wasn't anything like the extreme squeeze that was generated in previous recessions. What happened instead was that all of the last three recessions were generated by some kind of private sector overreach. The people got overextended themselves in some way. 1991, which is a long time ago now, my God, it was a little bit complicated, kind of a mix of stuff, but probably the biggest component was overbuilding of commercial real estate. 2001 was the dot-com bubble, and actually a lot of overinvestment in telecommunications, which was probably actually more important than the dot-com bubble. So it was more the laying too much fiber rather than pets.com. But anyway, there was again and then of course 2008 is the housing bubble and the and the burst, and what you used to call postmodern recessions, which actually look a lot like pre-World War II recessions, have tended to be the market, private sector gets carried away. Inflation has not been a problem, so this is the era of controlled, of anchored expectations on inflation. So the central bank hasn't felt the need to really squeeze the economy hard. It's allowed the private sector to run, and private sector runs on for a while, and the unsustainability of what it's doing is masked by a bubble or something. And then there's either the Minsky moment, or as people sometimes say, a Wile E. Coyote moment. Because I've noticed a lot of international people popping in here, so you may not know, but the old cartoons with Wile E. Coyote chasing the Roadrunner, and invariably he would end up running off a cliff. And under the laws of cartoon physics, if you run off a cliff into thin air, you don't fall until you look down and realize there's nothing under you. And so that's we've had those kinds of recessions, and it appears that that those are much harder to end. Partly because certainly in 2008 that there was less room for the Fed to cut to start with, but also because you're trying to instead of having imposed extreme pressure on the economy through high interest rates, and then you take away, and then the economy springs back, you have a situation in which the private sector has overextended itself, and you're trying to induce a extra spending in other areas to offset the spending that has gone away. By the way, obviously, I'm giving you a demand-side view of what recessions are about, which I think is crazy not to, by and large. But anyway, that's so you have it appears that recoveries from these overextended. Actually, sorry. I just want to mention although I don't know if anybody's actually read Minsky in full. But the phrase Minsky moment comes from Paul McCulley. It used to be at PIMCO, and he said rather famously at the beginning in the 2001 recession, the Fed needs to create a housing bubble to offset the loss of the tech bubble, and which is basically and which it managed to do. But it was, aside from the fact that stored up problems for later, it also was hard. So the recovery although 2001 was not a deep recession, it was a sluggish, extended, jobless recovery. Part of the issue, I'll just give you quickly this slide. I have my doubts actually whether I should have included it, but So yeah, the Minsky, Wile E. Coyote moment. If I believe, which I mostly do, the work on leverage as a as a major source of the last recession, then we came in having accumulated levels of household debt relative to GDP that were extremely high by historical levels. And that left you with an overhang of problems to be resolved, which helps to explain the sluggishness of the recovery. And so that's the story that I would have had. And then the okay, so historically, we seem to have two classes of recoveries. V-shaped recoveries following, well, historically monetary policy induced recessions, but I'll try to argue in a minute that there's a slightly more general version of that. And then much more sluggish recoveries following recessions generated by private sector overreach. For what it's worth, that's not just hindsight. Some people did warn that recovery was likely to be sluggish from the 2008 crisis. Actually, even before it had really turned into a full-blown crisis. So the upper left one is the famous Reinhard Rogoff, not the other one about 90% of GDP, but the one that really nailed it, saying that recovery from financial crises tends to be slow, warning that would be the case again, and with less data analysis by a factor of about 1,000. For what it's worth, I was saying the same thing at the time. So it was kind of there. This is not this vision that there are different kinds of recessions that have different kinds of recoveries actually made a successful out of sample prediction. Not everybody did that. I don't know if anybody remembers this, but the two very fine economists, Christy Romer and Jared Bernstein, when predicting the effects of the Obama stimulus plan, they got a lot of grief over having been over optimistic about employment growth, and people said, "See, stimulus doesn't work." But it turns out their without recovery plan also had a fast recovery in employment, and that the actuality was slow. And basically, they were like a lot of people were going with some version of implicitly with a plucking model, where the further out you pull the string, faster it springs back, and that's not what happened in the past. Okay, so my question is, those are the lessons of history, and of course we've now had a historically unprecedented slump, but that doesn't mean that unprecedented both in speed but also in cause. That doesn't mean that the history is useless if we can find the right mapping from the historical experience into this current crisis. Then it may be of considerable help. And so I have a hypothesis, which I'll share with you in a minute. And it could well be wrong. And furthermore, we may not even get a clear test, but that doesn't make me sound like something worth hearing. But anyway, let me try it.
I interject with a few questions now.
Oh, you want to give a sure. We can let's hold off on the screen share, and I'll give you my hypothesis afterwards. Sure.
So it seems like the distinction you make between whether there was an imbalance building up before the crisis versus there was not an imbalance is the most important distinction, more important than demand versus supply distinction of the crisis, and also more important, like Alan Blinder wants to know, the oil price shocks. You didn't mention oil price shocks or anything like that.
Yeah,
elaborate on this a little bit.
Yeah, let me say that. I mean, it's true that oil price shocks were behind the 74, 75 recession and the 79, 82, because they drove up the rate of inflation. And the and so the Fed was intervening to contain what it thought were wage price spirals. But I don't think either of those recessions, although there was a supply shock which drove up the inflation rate, the recessions themselves were driven by the demand side effects of rising interest rates. And so I don't think that yes, they were aggregate supply shocks, but the mechanics of it actually worked through the demand side. And uh, and part of the issue there was that there was a lot of indexation in the U.S. economy back then, so that shocks to CPI through oil prices fed through into wages and prices of non-oil goods. But I don't think I really think the important distinction is not supply versus demand. And I think if you go back further, we can probably find more examples. I would argue anyway that the important question is really whether the shock is in. Actually, I'm going to say that in the next slide. Whether the shock is really external in a sense, in a weird sense, but the Federal Reserve is raising interest rates, and it may be doing so because it's worried about the inflationary impact of an oil price hike. But the Fed raising interest rates, as opposed to recessions that come about for internal reasons because of the accumulation of unsustainable investments or debts by the private sector. Okay. Yeah. So actually, let me try that. We'll see if I can figure out. We're all experimenting a bit with technology. Yeah. So there's the argument. My hypothesis is that the difference in the shapes of recessions, or actually in the speed of recovery, is not fundamentally about whether it was interest rates or a financial crisis. So Reinhard Rogoff was saying financial crises are different. I was arguing that it was not, just more broadly, that private sector overreach crises are different. But it's about whether the headwinds are externally or internally generated. And if they are, if that is the right distinction, and that's what I'm arguing anyway, then the COVID slump could be more like 1979-82, which was followed by Morning in America, a very rapid recovery, than like 2007 to 9, where the overhang of debt and of excess construction of housing bedeviled the economy for a long time. Now, as everybody knows, there's other things in there. There's premature austerity and lots of other things. But if that distinction is right, the economy could come back very rapidly if the viral threat is lifted. I'll give you some possible alternative arguments in a bit, but just to say, even that right there, that's a very big if. And for what it's worth, the markets are not convinced. But then that question is what we should learn from that. So just for a second about the viral side. We all have access to the same material. The epidemiologists are. I actually wish we had something like the Booth School panel on epidemiology, where we could identify what the actual consensus of the profession is. But so far as I can tell, the epidemiologists are all of the view that point where any major reopening can take place without high risk of a second wave of infections. They might be right, they might be wrong, but it's epidemiology is a technical field and not one we know, so we should take that seriously. And sorry, I can't resist, but how not to predict the right. everybody probably knows, the Council of Economic Advisors got into the act fitting a cubic model to the cubic time trend to the data. And now they claim they weren't projecting, but that dotted line at the bottom sure as hell looks like a projection. And of course, given that, there are no deaths today, right? It's not, we're amateurs on this. We should trust the epidemiologists. They might be wrong, but they'll be wrong because this is an inherently difficult subject. By the way, one which involves human behavior as well as complex systems. So it's actually not, it's got many of the same uncertainties that economics has. But it's a, so even if we could be having a rapid rebound once the viral threat is lifted, question of when that will happen is still not very much up in the air. I mean, and it all depends a lot on whether the epidemiological response is adequate. If I were going to go for the W-shaped, my baseline is the Nike swoosh. But if we were going to have a W-shaped, it would be because we open up prematurely and the virus starts to explode and we lock down again, rather than because of some inherent economic arguments. Although there might be something there as well. The other thing to say is that interest rates, long-term interest rates, the stock, never mind the stock market, everybody knows the Paul Samuelson. The stock market has predicted 9 of the last 5 recessions, and beyond that, actually the impact of projected economic activity on stocks is ambiguous, because higher growth means higher future profits, but also probably means higher interest rates because the Fed will tighten eventually, and so it's not at all clear. I mean, probably the stock market goes up when people are more optimistic about growth, but it's not clear at all. That's certainly not a very clear. But the bond market ought to be telling you what people expect about future growth. If people expect a recovery that will bring us close to capacity and which will cause the Fed to tighten, then long-term interest rates should rise. And if people expect a slump that goes on forever, then you'd expect long-term interest rates to be low. And long-term interest rates are very low right now. They're real interest rate on 10-year is minus 0.5. The nominal rates are a third of what they were at the beginning of the year. The market is implicitly forecasting a slow, long recovery process. The market is pessimistic, does not believe that we can come springing back in effect. Which is something to be taken seriously. However, markets are great, but they can be wrong. There was a huge rise. There was a sharp rise in long-term interest rates in the first half, actually, of 2009, which, by the way, if you read financial reporting, there were an enormous number of newspaper articles that said that interest rates are rising because of debt fears, which was simply stated as a fact, not a hypothesis. And in fact, there was no reason to believe that was what was going on. What was happening was that people were, by and large, once the economy turned the corner, once the green shoots of recovery began to appear, they were predicting. They were basically, the market was into the plucking model and believed that the economy was going to come roaring back. And long-term interest rates reflected that. It turns out to have been wrong. We did not have a V-shaped recovery from the 2008 crisis. Now there is a question, and it does bear a little bit on this, of whether Marcus talked at the beginning about shift in the long-term growth trend. Maybe shift. There's substantial evidence that there's been a structural shift in long-term interest rates, that we are and short-term interest rates as well, that secular stagnation is a major concern. And people may not have believed that before 2011, 2012. It took them that long to realize that maybe this is kind of a permanent thing. That's also, by the way, a question that overhangs issues about the shift in the growth trend. How much of that is because of the effects? I mean, how much of that is hysteresis, the effects of the crisis, and how much of that is that actually we were fated to have a decline, but people were fooling themselves beforehand. But in any case, my point is that the fact that the market is acting as if we're not going to have a rapid recovery is useful, but it's not dispositive. The markets have been really quite wrong before.
Yeah. Check another question. So Jeffrey Frankl would like to know, are there any inflationary, so given that all policy measures will contain the Keynesian demand problems which might arise, do you fear there's some inflationary pressures building up, or the long-term interest rate being so low indicates the market believes there's more deflation danger than so what's your take on the deflation side?
Yeah, the question would be whether, here's how I put it. First of all, the monetary side, the zero interest rate world don't care about the monetary base isn't telling you anything. We're doing quantitative easing on a huge scale, although I would say that for those who are into this looks more like QE1 than QE2. QE1 was the initial large-scale intervention to basically plug the holes in collapsing markets. And that's really what we're doing here. And that's surely not inflationary. There's a question about whether fiscal stimulus could be overdone. That seems, I mean, I would say that actually there is a question. If you go back to the Gutierrez et al. Paper, you see that there is a possibility that depending upon intersectoral and intertemporal elasticity of substitution, that you end up driving up the prices of goods that are still available. But on the other hand, they could go down, and that's even if you fully compensate the people who are unemployed. At the moment, however, I would say that we're falling sufficiently far short of complete replacement of income, and the substitutions don't seem all that big. That it's certainly a possibility. I think Olivier has said that he's not. It's conceivable that we'll have inflation as this, but that's not his base case, and I'd be in the same position. That the overall we're probably still some net Keynesian drag on demand, despite all of that. And I would actually point out that among other things, that these compensatory programs are time limited. I would say too time limited, but the enhanced unemployment benefits expire on July 31st. The special business lending program actually only provides, they can only be converted into grants for 8 weeks. And the U.S. state and local governments. And one of the things about that jobs report last week was that the state and local governments account for a million job losses already. And there's considerable pressure. So I would say no, I'm not really thinking of inflation as a risk, though it's not in principle impossible, but it doesn't look like it's out there. And the market is telling us that expected inflation as measured by the spread on index bonds has gone down substantially. That may or may not be right, but it's not what I'm really concerned about.
So if I may summarize, tell me whether I'm wrong. So you believe in the bond market with regard to the inflation expectations, but you believe more the stock market with regard that we have a more optimistic V-recovery rather than...
I don't think the stock market is telling us about the pace of recovery either way.
Okay.
I think the stock market, if you look at the stock market, it very closely tracks the spreads on risky bonds. Basically, the stock market plunged as the incipient financial crisis emerged, and both the spreads between BAA and high yield bonds and corporate bonds and treasuries, everything turned around on March 23rd, and the stock market came back making up much, though by no means all of its losses. I don't think the stock market is telling us much about the recovery, and I don't actually. I'm not sure I believe the bond markets. The bond market is actually quite pessimistic. It's actually not simply saying that inflation will not be a problem. It's saying that inflation will be substantially lower than it previously expected. And I actually don't think I'm not sure I believe that, but also it's not clear that it is reflecting, can I say, complicating factors. I'm actually somewhat pessimistic about the actual pace of recovery, but not because of the economics, but because of the epidemiology. Actually, that's all my slides, but let me just say a few more words. And so what may I be missing here? First of all, everything depends upon the epidemiology. And if it's really going to continue a descent, if opening does not cause a significant rise, then I would believe that a quite fast recovery is possible, subject to the things I'm going to talk about in a minute. But doesn't. I personally have become a lot more pessimistic about that, but that's only because I'm listening to the epidemiologists, and because our government does not seem to be listening to the epidemiologists. And so, and for what we've seen, for what it's worth, international experience has been that countries that have been far more successful at containing COVID-19 than the United States, like Germany or Hong Kong, not Hong Kong, they haven't had the problem, South Korea, once they began opening, they did tend to have new outbreaks. And we may get some information on that quite soon, because that apparently people are jamming into the bars in Wisconsin, and let's in about 2 weeks we should have some notion about what that is doing. The thing that I'm, I guess, most concerned about in terms of that, have I got this wrong, involves whether the lockdown is itself inflicting substantial structural damage. And that's kind of this severing relations of employees with their employers, and takes a while to reestablish those. Businesses, particularly small businesses, large businesses can do Chapter 11s, probably not liquidate in most cases, though not always, but small businesses that simply cease to exist. So once people are willing to go back to restaurants, or able to go back to restaurants, maybe there are no restaurants, that sort of story. Jerome Powell's testimony to Congress was very heavy on the structural damage issue. He was basically, aside from pleading with Congress to provide more fiscal relief, he was in effect warning that if it does not, that there will be a lot of hysteresis, that there'll be a lot of structural damage to the economy. As far as I can make out, he didn't really say that, but I think we should be thinking about not just businesses that go under and take a long time to reestablish, but also household balance sheets could end up being stressed because during the lockdown, to the extent that, particularly actually, if the unemployment benefits that have made such a big difference so far, if they expire when the economy is still in a virus lockdown, then you could see people with households with depleted savings, much worse in balance sheets. You could see a lot of firms that have borrowed to try and stay afloat, and then are crippled by the debt, even if they didn't fail during the initial period of lockdown. So there may be some other stuff going on there that is not really, I don't think we've managed to model. But for what it's worth, I'll just say one last thing. In saying that, I thought we could probably have that this is more like 79-82, and that a Morning in America style recovery is more possible than people think. That's not what I want to. For what it's worth, my biases, both character and political, lean the other way. That is, I tend to be a pessimist on these things, and I also you can imagine the idea that the U.S. economy might be roaring back just in time for November is not something that makes me particularly happy. But but it is, at least my read of it is that if you think about it in terms of the fundamental question of what causes a recession, determining what the shape of the recovery is, that this is more like the tight money recessions that preceded the Great Moderation. It is like the private sector overreach recessions since the beginning of the Great Moderation, and then and that therefore we are better poised than many people think for rapid recovery. End of.
Thanks a lot, Paul. It's a great hypothesis. I really like it, and it's very optimistic. And I would like to know, how would you test this hypothesis? You could probably look across countries where saying, well, some countries, if I summarize your hypothesis, if policies are right, we might have a sharp recovery, a very fast recovery, conditional that the virus component is also taken care of. But we could test this across countries. There are some countries who have other different policies. Or would you say the correlation, the interconnections in the international global economy is so tight that there's no way to really test this?
No, I would think I would think that we would want to look hard at countries that have been more successful. Well, how fast is the? There is a list of countries that appear to have been quite successful at containing, and South Korea, China, actually, although no one actually really trusts their data, but nonetheless, the fact is they follow the draconian control procedure, and New Zealand. So we will want to be watching those. Now, as we've seen, there has been some virus rebound in some of these countries, but I would particularly be interested to see with South Korea. They had obviously an enormously more successful control program than we have had, and although they have had a partial resurgence, although they caught it very quickly, so they end up closing bars and nightclubs. So they're, but on the whole, they're still in the process of reopening. Now the question might be, South Korea being an extremely open economy, how much of an independent recovery can they have? But I still think you'd want to be looking at that. So, and Germany, much bigger economy, also rather tightly integrated into the global economy, but Germany is clearly much further along in this than the rest of us are. So keep an eye on whether these countries can have rapid recoveries. I have to say the very, very early anecdotal evidence from China is not too favorable to my hypothesis, but it's very, very early. They've been opening up, but consumer spending is still very depressed, and so but it's very, very early days.
So I have a number of questions from the audience, which are more policy related, less to your grand hypothesis. And in particular, people are asking, should we give subsidies to employers or employees? What's your take on that? Do you like the Danish approach versus the US approach on that? And with regard to short-term work or this Kurzarbeit concept, what's your take on this, if it turns out to be a longer lasting crisis?
Yes. Okay. My views on that are muddled, but because I think that, broadly speaking, there's a North American approach and there's a European approach. It's not totally right, but think of it that way. And the North American approach is enhanced unemployment compensation, and the European approach is wage subsidies to keep people employed. And now the U.S. it's not pure. They have had unemployment benefits as well in Europe, and and in general have much better replacement of income than we do. And the small business lending, the PPP program, is with loans that turn into grants if you can show that they were used to meet payroll. It's kind of like a European thing, but that program's been something of a disaster. The North American approach and the initial parts of the North American approach didn't work too well here, although there was a much more successful opening stage in Canada, which actually has the enhanced unemployment benefit similar broadly to what the US is doing. But instead of running it through state unemployment offices that have computers that run on COBOL, established a federal web portal and hotline, and people were able to get the benefits within days. But the US one is kicking in now pretty seriously. The disadvantage of the American style one is that if workers lose their relationships with their former employers, it may be costly and time consuming to reestablish them. The disadvantage of the European style program is that it presumes that the post-COVID economy is going to be pretty much the same as the pre-COVID economy. And if we are in fact going to experience a lot of induced structural change with more delivery, more remote conferencing, all of those things, then you actually want to divorce the relief payments from the previous job. So the principle in either case is that you want to largely hold people harmless from the economic impact of the lockdown. It's not really stimulus; it's really disaster relief. But then the question of whether it's kind of this flexibility issue. The North American style one creates maximum flexibility, but possibly disrupted relationships. The European one maintains the relationships, but has less flexibility. And I don't think we know the answer to which one is going to turn out better. And the Kurzarbeit again. If extended hours, short hours and job sharing so that people remain employed in a vastly shrunken travel and hospitality sector is great if you think that travel and hospitality is going to come roaring back to where it was. But if you think that this whole let's get together for conferences by having everybody fly in from all over the country is going to be a persistently much smaller thing now that people have learned how to use Zoom, then it's not such a great idea. So I'm not sure that one is better than the other. I think we don't know.
Thanks. So let me close with a final question, because there are a lot of questions about emerging economies, and we haven't touched upon the emerging economies. Do you have a particular message? What should policymakers in emerging economies consider in particular? And everything in 2 minutes.
Yeah, no, it's just, I'm just starting to get my act together. Let me say that as I read it, I talked about how the financial spillovers have been contained. That's mostly true for OECD assets. The Fed has gone to incredible lengths saying it's willing to buy junk bond ETFs. It has not said that it's willing to buy emerging market debt. And I think presumably it can't. The Fed can't. The Fed would face political hell if it did that. And the ECB probably can't even buy Southern European debt at this point. So so I actually am concerned that we may have, for emerging markets, a much more traditional sort of financial crisis. And I'm still trying to figure out things have changed a lot in emerging markets since the late 90s, where a lot of us got our baptism in this. The original sin, inability to borrow in their own currency, is no longer a big consideration in many of these countries. But how much latitude does that give them? And the answer is I don't know. And I will probably try to figure that out within the next 2 weeks, because that's probably the next but one session of Krugman Today.
Fantastic. So I recommend everybody to zoom in Krugman Today in 2 weeks to learn more about emerging economies. Thanks again, Paul. It was fantastic to have you here and for providing this big hypothesis. I think that's good to have, a clear message. And hope to see you soon here in Princeton.
Okay. Hope to see anybody soon in Princeton. All right. Or anywhere else. Take care all.
Thanks again. Talk to you soon. Bye.